When you look at the quality of debt that's out there right now, a lot of people have been pouring right into debt, and junk debt in particular. Is it riskier than it may seem?
Well, the index itself is getting lower quality. It's eroding in credit quality, so that inherently makes it riskier. When I talk to my sources, it's interesting. They believe that they're being compensated with the high yield, though. So you have to always remember that there is a downside risk in this market. It is a super risky market. There are chances that there are going to be defaults, and in a smaller credit universe, that chance is going to go up. But investors are still piling in. They love junk bonds.
They love junk bonds. They love the returns, right?
Yeah.
But you're saying that basically right now the risk reward, at least in their perception, is still in balance?
It's still in balance in their perception, but it's really interesting to sort of analyze, because if you look at spreads on a 5-year average, on a 10-year average, they're way below that.
Right.
So there really isn't much compensation on the spread level. It's all coming from the yield.
How do you know that they are protected against any risk of default at this point here? This is all assumes some brighter outlook for the economy. But if more and more companies are facing risk of downgrade, doesn't that seem to say the opposite?
There's definitely a risk that defaults could move higher, and I think it's something that investors need to consider. They're investing in a riskier market now. But
riskier relative to what? Because I mean, when you talk to some of these people, and obviously they have a long bias here, but the idea is that we're nowhere near sort of those sort of blow up stages that we saw, either whether you want to compare it to the global financial crisis or anything else here. So what is the fear?
I don't think there is a lot of fear in the junk bond market right now, and I think that's why we're seeing spreads tighter. To Shonali's point, yes, there is a chance that defaults could go higher, but my sources are not too concerned about it right now. They say the risk is contained.
Well, it's interesting. This all comes as you're seeing high-grade bonds also being issued at a rapid clip. You're seeing about $50 billion of corporate debt sales just this week, a lot of that tied to M&A. Are the spreads here looking commensurate to what investors really want to be getting out of fixed income right now?
When you think about the M&A pipeline, especially for investment grade, you would think that all that supply that's coming and all the supply that we have seen would push spreads wider. But in fact, Bank of America actually had a report out today saying that they think because of demand that spreads can move tighter. So you would think, given all that we're saying, that yes, there's a risk that spreads would widen, that defaults would go up, but it's just not being priced into the market.
Is the market as big as it used to be? Is it getting back to where it used to be?
It's actually getting smaller, Romaine. So you have companies like Ford, Kraft Heinz, Occidental Petroleum. They were all downgraded into junk in 2020 during the pandemic. They've all left. They're back in investment grade now. So you have some of the healthiest, strongest companies that were sort of propping the junk bond market up a little bit. They're no longer there anymore. Yeah, we just showed that graphic. There are quite a few upgrades that we've seen over the last couple of months, which surprised me. But when you look at the rationale that some of the ratings companies had, I guess it kind of makes sense, at least for Ford, certainly for Occidental.